Welcome to the Passive Income Podcast. I am your host, Dividend Dave. Please be sure to join the Passive Income Posse by clicking that subscribe button below. Super excited for today's episode. We are taking another trip across the pond to the United Kingdom. Joining me is David. You can find him on Twitter at Dividend ENG, Dividend Engineer. David, go ahead and give yourself an introduction.
Okay, first of all, thanks for having me on the show. So I'm from the UK, as Dave just mentioned. It's interesting that we've got the same name, by the way. It's always
Yeah.
nice to meet other Davids. Yeah. So I work as a software engineer. So that's where sort of the title comes from, dividend engineer. So love dividends, but also love software engineering. So that's what I do pretty much as my main job, 9 to 5. But on the side, I do as well do a little things. I do, for example, some day trading on the side. And so any capital that's coming in from my main role or from the side income I do, I usually put majority of that back into dividend stocks.
Right.
That way, basically, what I'm trying to do is build up my passive income levels to almost match up my active income levels. So, but in a nutshell, that's sort of who I am. I don't know how much in depth I should go as part of this intro.
No,
Yeah.
that's fine. That's great. That's perfect. So yeah, software engineer, and that's where the dividend engineer comes from, and then dividend investing. So how did you get into or find dividend investing? In the beginning, because quite often so many of us start out making the mistakes of like penny stocks or all sorts of countless errors and numbers of mistakes that we can make before we find this nice, smooth, easy, somewhat like I like to think it's an easy path of dividend investing.
Yeah. I think my journey began probably about, say, late 2019. So it was around the time when I had started taking sort of money a bit more seriously than I was before. So
Right.
obviously, I spent some time doing some research online. So I never went into like penny stocks or anything. I sort of went into like ETFs. That's sort of how I got into it. Sort of S&P 500 sort of started there. And then from there, that's when I then looked into what positions are included in the S&P 500. Obviously, then found out what stocks are in there. And then that's sort of how the journey began. And then from there, eventually discovered dividends.
Right.
So, and then that's where the excitement really kicked in. And that's when I then obviously started doing my own research and picking more stocks that way. Yeah.
Yeah. So you were smart right off the hop to do a whole lot of reading and research and figure things out before you jump in, because a lot of what you see on Twitter is people saying for any beginner you probably should just start with an ETF, and exactly like you said, an ETF that matches the S&P 500 or something similar to that, and
Yeah,
try to make it
exactly.
easy on yourself.
Yeah, that's right. Because at the same time, I think my initial approach was I also didn't want to lose money. So I thought,
No.
fair enough. So what can I do that's relatively low risk? Obviously, everything has risk at the end, but what's relatively low-ish risk?
Right.
And that's sort of how I went into ETFs and also looking at some of the all-world ETFs, some of the global ETFs,
Right.
which is one of my highest positions at the moment. And that's sort of how it started. And then from there, just look at what companies are in there. Obviously, it's looking at Microsoft, Apple. I'll probably talk more about bit about those a bit more later.
Sure.
But yeah, that's sort of how the journey began. And then obviously it's just kicked on from there. Seeing that passive income come in just
Yeah.
gets you more exciting. Obviously, initially at the start, you get those small dividends. Maybe say it's like 30 pence or I don't know, 50 cents.
Yeah.
It's small, but because it's, you've made it passively, you'll get excited that way. And obviously, you then aim to increase that month by month or year by year. And yeah,
Yeah,
definitely excited
exactly.
about dividends.
No, I agree with you 100% there. Like those first few dividends that come in are, like you said, very low. And then, but you still get kind of excited about it. You're like, wow, I just made, like you said, 30 pence or 50 cents or whatever it may be, or even a dollar or a quid or whatever it happens to be. And you're like, wow, that's amazing. And then you just like the wheels start turning. Well, how do I make that $1 turn into two, turn into five, turn into 10, right? And you just like, you get a little bit addicted to the whole idea of the passive income from dividends.
Yeah, And that sort of leads me on to how I then started picking my stocks. Because obviously, early on in the journey, I find that when you get more regular dividends, that does something to you mentally, where you get
Yeah,
more motivation to keep the whole journey going forward. So then I sort of tried to align my stocks in a way where I can at least get monthly dividends, because most of them pay quarterly. A lot of the ones I had initially, they would sort of pay in June. So which means
right.
I would then have to wait another few months before the next dividend comes in. But I want to see that regular income come in just for motivation as well.
Yeah.
But also it's just nice to get monthly income. It feels like this it's actually happening now. I'm getting that passive income.
There's
Yeah.
something very psychological about seeing that money arrive in your brokerage account every month.
Exactly. And that sort of leads me on to some of the different stocks that I have. Obviously, I mentioned initially that I did have sort of global ETFs,
Yeah.
but then eventually I then started looking into, well, what pays monthly? Because obviously I want monthly income. That's how I then stumbled into some different REITs that are available. Maybe we'll go into that later.
Yeah, for
But
sure. I love
now,
REITs. Let's dive into
yeah,
REITs all you want.
yeah, REITs. I mean, because I'm from the UK, obviously I did start off looking at what is available in the UK, what can pay me monthly. Just based on the research I did at the time, I didn't really find anything that was going to pay monthly. So eventually, obviously, digging further, I came across realty income, which I think a lot of people love. Seems like everyone has it in their portfolio these days. The only downside to that is because I'm in the UK, I have to sort of I lose out a bit because I have to pay that 15% tax.
Right.
But otherwise, that's definitely one of my favorites. So you get that monthly income. Obviously, any profits I get from that, I then reinvest that back into those same monthly payers. At the moment, the two monthly payers I have Realty Income and Main Street Capital. That's also another US company.
Okay. Yeah, I'm less
And
familiar with Main Street Capital. I have heard about it before, but obviously I've the majority of American guests I've had here on the Passive Income Podcast, like 98% of them do hold realty income, and even a lot of the Canadians have realty income. And I don't think you're the first from the UK either that I've had here on the show that has also had realty income. So like exactly like you said, it's a fan favorite. It's very popular in the Div Twit community.
yeah, and also with Realty Income, I think just looking at their history, I mean, it's hard not to want to buy into it. You look at how the growth, sort of annual growth,
Yeah,
also dividend increases. It's hard to look at it and say, no, I'm not interested. Especially when you look at the dividend yield as well. I think at the moment it's just over 5%,
right.
which is higher than most stocks, and you're getting a sort of stable-ish company as well, which its holdings are diversified as well, just in terms of what it does, where the properties are.
Yeah,
So, I mean, it's hard to sort of turn it down. And the other side of that as well, because it's real estate as well. It's based on real estate. You sort of feel a bit as though you're a landlord. So when you get that
exactly.
monthly income come in, all right, okay, fine. My tenants have paid me this month. That's good.
Yeah.
So it's nice to have that monthly come in. It's very motivating.
So it sounds like Canada is a little bit on the flip side. You said you weren't really able to find any monthly dividend payers in the UK, whereas here in Canada, I have several REITs that all pay monthly,
All right. Okay.
which is nice, good for me, basically. And again, 5% is 5%, whether it's paid monthly or quarterly. But going back to what I said, it's that nice psychological boost of just seeing the cash arrive in your brokerage account on the
Yeah.
16th of every month or whatever day it happens to arrive, right?
Yeah. So with those, since you have so many options, then do you also hold realty income, or you're just happy with all the Canadian ones?
So as of right now, everything I have is in the Canadian market, and the primary reason is the exchange rate. The Canadian dollar is rather weak against the U.S. dollar right now, so I really feel I'd be losing out quite a bit on just the exchange alone. And
Yeah.
we're a little bit luckier here. Depending on which account you have, you can find your ways around that 15% withholding tax. So that one isn't really an issue for me. But yeah, like you said, I have so many options with REITs here in Canada that I'm happy with the ones I have here. And yeah, I have nothing against realty income. And if the Canadian dollar ever goes back up to to a stronger position that has been in the past against the U.S. dollar, then yeah, I will definitely look at a few different U.S. positions.
Yeah. Okay. Yeah. I mean, I don't personally hold any Canadian stocks as individual companies. Obviously,
Right?
the ETFs I do have, they obviously will have some
Yeah,
sort of Canadian holdings within them. Yeah.
makes sense. Makes sense. So I don't know which way do you want to go here. Do you want to just kind of go down some of the lists of I saw there on your Twitter profile. I think is your pinned tweet about like Vanguard and a few others like that. Do you want to go through that or jump into some of the individual holdings that you have?
Yeah. I could sort of go through my just portfolio in terms of
Sure.
biggest. Yeah. So at the moment, the largest one I have that it's ETF VHYL. So it's an all world high yield dividend. So that's a dividend yield of about 3.5%. Reason I like that is because mostly because it's diversified. So it's a
Right.
global ETF, which means you're going to have all the top sort of large cap and medium cap companies pretty much globally. I
Right.
think just looking at the stats, I think about 40%, 46% of the holdings are North American. So that would be a split between, I guess, Canada and the US, and then 26% is Europe. And I like the ETF mostly because of the income side. I think, like I was saying before, my main goal with this whole journey is just to improve the passive income numbers that I'm
Yeah.
getting. So obviously, the higher the yield, the better. But at the same time, you don't want to get a yield so high that
That
you're
it's not
buying a bad
sustainable.
product.
Yeah.
Exactly. So at least with the ETFs, because of the diversification, I'm sort of happy with that kind of number. And I think looking at the sectors involved with that, so it's 24% based on the financial industry. I think that's the largest sector in that.
Right.
And that's usually where the highest dividends get paid from.
Yeah.
And it's very different to my second
Before you move on to
holding.
your second, I just have a
Okay.
question there. You said North America and Europe, so I'm guessing there must be Asia in there as well.
Yeah. So North America, 46%, Europe, 26%, and then the rest are quite small positions, sort of spread between Africa, Asia. I haven't got the percentages in front of me,
Right.
but it
Probably
doesn't really
maybe even
compare to like the 26%.
yeah.
Yeah.
I'm wondering like even if Australia's in there, probably a little bit, right? It's if it's global, it's
Um, it probably is. I mean, it's pretty much all the large and mid cap. I mean, there's a 1,770 companies within that ETF.
holy wow.
So I'll be surprised if Australia's not in there. I'll
Yeah,
be very
yeah.
surprised.
That's quite
Yeah,
the job for whoever the money managers are on that one, keeping track of over 1,000 different companies.
exactly.
But that's
Yeah, I
why
think
we that's why they do it, and we just reap the rewards of of having an ETF.
exactly. That's another benefit of ETFs as well, because you can do all the research yourself, buy all the companies, or just buy an ETF that will have
Right.
everything included. All the companies, they'll do the research, especially with this one, the growth as well. Over the last 10 years, you can see sort of consistent growth. I think it's about 80% growth over the last 10 years. And obviously, just looking at how the market moves as well, you can assume that it might do something similar in the next 10 years. Obviously, nothing's guaranteed,
Yeah.
but you can roughly estimate that it might be still going upwards.
Okay, moving on to your second position or second biggest position.
Yeah, so second, also an ETF. That one is VWRL. You might have heard of that one. So that's an all world ETF based on the all world index. Reason I love this one is you sort of get three things out of it. Whereas in the previous one, you pretty much it's mostly the high dividend yield. The
Right.
growth is not as good as maybe some individual stocks or other ETFs. But with this VWRL, so you get the growth, you also get the dividend, and you have sort of stability. And what I mean by that is in terms of growth, I mean it's almost matches what the S&P 500 does in terms of numbers. In terms
Right.
of allocation, it's like 62% North America and then 16.2% Europe.
And then the rest
and
of the world for the remaining
rest
percentage.
of the
Yeah.
world, yeah. So this one's a bit larger. So 3,691 companies.
Holy,
Again,
who are these money managers that are tracking 3,000 companies in one basket of funds?
yeah, I believe it's Vanguard. So Vanguard manages that.
Right. Yeah. Yeah. That's usually what the V at the start. It's usually Vanguard, if not always. So.
Yeah, that's right. And at least with this one you get more growth. So with the previous one, obviously dividend yield of 3.5%. This one you don't get that. It's much smaller at 1.8%, but you get a lot more growth. And you sort
Right.
of understand that when you look at the sort of what companies it's holding. For example, the top 10 companies within this ETF pretty much match the top 10 in the S&P 500. So you've
Right.
got your Apples, you
Apple.
got your Microsofts, and just looking at these top five, actually, the top five: Microsoft, Apple, Amazon, Nvidia, Alphabet, Google. So obviously that already makes up 10% of the ETF.
Right.
So you can sort of see where that growth is coming from. And
Yeah.
in terms of sectors, so 24% of this ETF is in the technology sector, which
It makes
explains
sense.
why the growth is quite nice actually.
Yeah.
And you get the dividend as well. Obviously, that's my favorite part. So growth plus the dividend, it's only 1.8%, but when you look at the growth you're getting as well, it's nice. I love it. It's definitely
Yeah.
my favorite.
For
Yeah.
sure.
And in terms of the holdings, so Microsoft is top with 4%. So I'm a big fan of Microsoft. I do hold it as an individual position as well. And being a software engineer, I can maybe just sort of run you through where I'm using Microsoft products throughout the day.
Yeah. Sure.
So, for example, so obviously I'm using a Windows laptop to do my work. That's Microsoft.
Yep.
Log into Windows and then open up my code editor, the one where I write all my code. That's again owned by Microsoft, program called Visual Studio. The programming language I'm using, C Sharp, well, mostly using, that's also by Microsoft. And then if you want to host any applications, so when we publish our app, we might host it in Azure, Microsoft Azure, which is their hosting platform.
Right.
That's also another Microsoft product. So I'm a big fan of Microsoft. I mean, if I could, I would literally just base the whole portfolio off Microsoft, but the yield won't be as great, and also just having one company is probably not the best idea
No.
usually.
Just
Yeah,
to add to the Microsoft, like I use Microsoft every day too, but I'm in an office environment, and so it's those very simple office tools of Outlook and Excel and Microsoft Word and PowerPoint and just that very basic bundle. But think about how many offices around the world use exactly what I'm using every day, right? So
yeah,
totally different
hmm
level to what you're on, but massive, massive distribution.
yeah. And also when you look at for example, other industries they're in, I think AI as well. I mean, there's a
Yeah,
lot of talk about AI now. Microsoft's been looking into AI for a long time. Also, I'm sure you're familiar with Chat GPT, right?
yeah. I've obviously heard about it. I've been to the website, but I haven't really dug into it. I haven't dug into it any more than that.
Yeah. So again, I think that's just an example that they are active in the AI industry. I mean, if you're a fan of the Edge browser, you sort of get access to Chat GPT pretty much
Right,
for free, and you have access to sort of those creative tools. For
right,
example, if you want to create a logo, for example, you can just type in your prompt, create me a logo which has these colors, have this image in it, put that into ChatGPT in Microsoft Edge. And then a few seconds later, it will pretty much do that for you. You'll have a nice logo there. You can then tell it, tweak it, actually, no, change the color to this, add this image instead, maybe make it a bit smaller, make the border like this.
right.
And it's just nice that you have that right off the bat, which is why a lot of people now might start using Edge over Chrome.
Yeah, interesting.
Whereas, yeah.
That's very
So
interesting.
as you can tell, I do love technology.
Well, it
I'm a
makes sense.
soft.
You're a software engineer, so it go with what you know, right?
Yeah, exactly. And that's why I like this ETF as well, because 24% is based on technology. Can't really complain about that. You're getting a decent dividend yield, 1.8%. That's quite nice.
Hmm.
I think in another lifetime, I would probably just hold this ETF as well, and then maybe have a few small companies. But so that's why that's my second largest holding. I love the growth, and I love that there's a dividend yield coming out at the end of the day. And
How many
next
total
one after
ETFs
that.
do you have?
So I have three in total. I do have a small position of the S&P 500, but a lot of those companies in there sort of correlate with what's in VWRL. So
Right.
I've just kept it as a small position for now. Otherwise, my exposure to the US market then becomes more than I would want it to be. So it's just those three. And then after that, that's where I then have my REITs. That's where O comes in. That's my third largest position, realty
Right.
income. And
Interesting.
that's sort of 10% of my portfolio. My goal here is to make the ETFs about at least 40%. So 40 to 50% of my portfolio. Ideally, I want that to be mostly ETFs. And then the rest I'll split between individual companies and then some REITs as well.
Right. And the reasoning there is just because your ETFs are primarily global, so you have access or exposure to the entire world.
Yeah, it's more to do with diversity, growth as well, and because they are ETFs as well, I would say it's a bit more stable than picking an individual stock.
Yeah.
Obviously, my opinion on all this potentially could change, but I've only been sort of taking sort of dividend investing seriously sort of since the start of this year.
Right.
So you can technically say I'm still in the early stages of this journey.
Yeah.
So
But
yeah,
you're
things might
starting to
change.
watch that snowball grow where you're like, "Oh, wow, I'm just getting a little bit more, adding a little bit more every month, every quarter. There's just a little bit more coming in and I'm okay with that." Right? Like I'm okay when
Exactly.
more money just shows up in my account.
Yeah. And like I was saying earlier, so usually most of my income, so obviously pay my bills, whatever's left over, I try and keep like a savings rate of about 60%.
Wow.
So 60% of what I get in my bank account, I will sort of take that, put it into dividends. And then what I get from the other income I was talking about, the day trading, also I'll also take that and put that into dividends. Obviously, because that's different income, I have to sort of consider tax and things like that.
Yeah.
So each month my portfolio is growing, and like month by month, I am seeing the results already. So my realty income payment, for example, every month it's sort of going up and up. And
Yeah.
I do want to get to that position where that passive income is almost catching up to the active income. So each month I'll keep topping it up, topping it up. Eventually, one day we will catch up. Hopefully, not just
Yeah.
catch up, but overtake it completely. That would be nice.
After realty income in your individual stocks portfolio, what's second?
So after realty income, that's where you've probably heard of legal and general.
I knew that one was
You've
coming. I knew I
probably
knew it was going to be that one.
Yeah, that's a big fan favorite in the UK. I think a lot of investors love this one
Yeah, for
because
sure.
all
You
the numbers
definitely
look good. It's sort of
everyone
it's
that I follow or follows me on Twitter that's from the UK talks about legal in general, and I think every other UK guest that I've had here in the past has held legal in general as well. So, like you said, it's
yeah.
definitely a fan favorite in the UK.
I mean, it's hard to. I mean, when you look at what they do, I mean, just for those that don't know, so they are a financial services company. So they provide sort of pensions, different types of insurances. They also do some investments as well. They can sort of manage investments.
Right.
And when you look at their numbers, it's hard to sort of say no to them. I mean, they have a high dividend yield, which is about 8%.
Yeah.
But at the same time, looking at their track record, their growth, looking at the sort of capital reserves they have, it's hard to say no to them, especially at an 8% dividend yield, knowing that they're a relatively stable company.
And if I'm not mistaken, their actual stock price isn't that high. Like, what do they trade at?
I'm
roughly?
gonna have to double check that. But but you are right. Yeah, definitely not expensive to get into. I think one share is about is it £2? Let me double check.
Was it? It's that low? I thought it was more in the 5 to 6 quid area, but I
It
could be
might be.
mistaken.
It's been a while since I looked at the price, but it's so yeah, one share is £2.24 just for
Holy
one
wow!
share.
So yeah,
So
yeah, it's very low barrier entry as well on that one.
yeah, so most people watching, especially if you're from the UK, I mean, obviously, I'm not gonna give you financial advice or anything,
Not financial
but
advice, just two people talking.
if you did want to go down a route where you have ETFs and then squeeze in legal in general, no one's gonna blame you for doing that.
Yeah, exactly. No,
Yeah.
yeah, I definitely understand why it's a fan favorite with, like I said, that lower price, so you can rack up quite a few shares relatively quickly, and an 8% yield on what most people, the majority of people, see as a stable and growing company. So yeah, it really does seem like a no brainer for those of you in the UK.
Yeah, most definitely. And also you can see that compounding effect happen. Maybe not as quick because they only pay twice a year. That's maybe one of the
Oh, the
downsides of
drawbacks,
it.
right?
But when that dividend does come in because I got the one in June, so I mean you do get a very nice payout. It does sort of bump up your total monthly total to a nice big sum. But then you can
Right.
just reinvest that. And you can just imagine if you've bought a number of shares, you get that payment from Legal and General, put that back into Legal and General. This time next year, you'll get a lot more back.
Yeah, for
So
sure.
you see that snowball happen.
So if they pay twice a year, it would be June and December. Is that correct?
June and no, it's not that far apart. It might be like August or September. But the June dividend is much bigger, and then the second payment is a lot smaller. It's almost half of what you would get in June.
Oh,
So it's
that's interesting.
yeah, so June is where you get most of your legal and general profits from. So
Wow.
which is why if you're trying to base a portfolio just off legal and general, you're only going to get two payments and only one of those will be a very nice. I mean, the second one is still quite nice because of the high yield,
Right.
but that's why it's good to have legal and general balanced with some other stocks as well,
Yeah, for
just so you
sure.
can get that regular income coming in.
Yeah, I understand that wholeheartedly.
Yeah.
Um, After legal in general, what else do you have?
So legal and general, I think I mentioned I've got Main Street Capital. So
Right.
that's sort of in terms of portfolio allocation, that's the next one down, Main Street. But that's for the, so like I said, Main Street and Realty Income, those are the only US companies I'm holding. And then after that, it's pretty much just all UK companies. So you may or may not have heard of some of them.
For
So
sure.
things like I've got Tesco in there. I've got Taylor Wimpey, which is a building, so they build new homes. I've also got a bit of
Construction.
Tesla actually, so that's also a US one, but that's a very small position.
Right.
I've got a good number of a sort of renewable energy stocks there. I've got three in there, and then obviously my favorite, I've got some shares in Microsoft and GSK, which is a pharmaceutical company. I've got some shares in that one as well. Barclays Bank, BP as well, and yeah, but that's pretty much sums up the rest of my holdings. They all have sort of equal allocations, so it's not
Yeah, and
like
that's
one's a
great.
yeah.
That's great
Mhm.
diversity. Like, correct me if I'm wrong. Tesco is a grocery store chain in the UK.
That's right. Yeah,
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 so you're into the consumer staples there. Obviously, people have to eat every day, so people go grocery shopping all the time. People are going to spend money in the store like Tesco. You mentioned BP, British Petroleum, so you're into sort of the oil and gas sector as well as I know BP is into the renewables. Um, you mentioned
hmm
a construction company as well, so you're into the
yes,
building materials and all
yeah,
sorts of things there. Yeah, so you very diversified. I like it.
Yeah, there's one I left out, Rio. So they sort of do mining,
Yeah,
sort
Rio
of mining
Tinto.
related. Yeah. Are you familiar with them? Yeah.
Yeah, well, they're a
Yeah.
huge global company as well,
Yeah.
like BP, right?
Yeah. So that's sort of, I mean, in total, I have 25 different stocks that I'm holding. So the
That
whole
was my next
portfolio,
question.
yeah, so 25 in total. Three of them are ETFs. So the ETFs take up about 33%,
Yeah,
and then the rest is all stocks. I do have some crypto as well, but it's not substantial enough to sort of compare to the stocks or the
right.
ETFs.
Our
Yeah.
portfolios are actually very similar because I have about that same 24 or 25 total positions, individual stocks, plus I think I only have two ETFs. Um, but yeah, that's and out of all of them, they all but one pay a dividend. I just happen to have one that is a lithium play, and that's sort of my play in the EVs because
Oh,
obviously there's
okay.
going to be a lot of lithium needed to be mined for all these EV batteries. Um, and right now, that's the only one I hold that isn't a dividend payer, and everything else pays a dividend either monthly or quarterly. So
Yeah, that's probably going to have some potentially have some good growth as well, as
yeah,
that's in
it's
the sort of
already kind of
renewable.
been um, up and down. Like it was again going back to a low dollar cost share. I think when I bought it, it was like I want to say in the 380 $3.80 Canadian range, under four. And at one point, it was as high as I think 12 or $13, and then it's kind of track back down to five or in that range. And so I'm just holding it. I don't have a lot of it, a few shares, and sort of see where it goes.
Yeah. Okay. Yeah, renewables. I mean, that would technically count as being in the renewable energy sector, right? That would be with the batteries,
Well,
maybe.
it's lithium, so I don't know. I think it might be more the mining sector.
Probably more mining, yeah. Okay, because some of the renewable energy stocks I'm holding, they also do have some investments in sort of battery technology.
Right,
And that's sort of so a lot of them are solar based, so they have their solar farms, but at the same time they will try and have these battery farms as well,
right.
where they
Okay,
can sort of, if there's a scenario where there's sort of a grid down event, that battery storage could maybe power like a small town for about, I don't know, a few hours or something. So yeah, so it would be interesting to see what happens over the next 10 years just in terms of renewable energy and what direction that heads in.
sure. You mentioned Tesla there as well. So as we're kind of talking about renewables and EVs and EV batteries, I guess thoughts on Tesla. Sounds like you have a very small position in Tesla, but
Yeah, it's very tiny. I think when I started earlier this year, it was, I think, the second one I bought. But honestly, I just bought it as a bit of fun. Like it was nothing serious. I wasn't like counting on growth or anything from it.
right.
So, so yeah, that's very, yeah, it's like zero point 0.1 of a share. So it's not much.
It's not retirement money coming in when it.
No, not at all. But
Awesome.
yeah, technology is where my, that's where my heart is.
Yeah, for sure.
Yeah. Mhm.
No, I think you're setting yourself on a great path to that financial freedom where you have that passive income that someday it's going to be able to pay all your bills, which is
Exactly.
the goal, right, for everyone.
Yeah, that is the goal. And what I love about that though is that you're investing in your future self. So it's like what you're doing now, the money I'm putting aside now, the dividends I'm getting now because of that snowball effect. 10 years or however many years from now, I'm going
Yeah,
to be looking back and thanking myself.
yeah.
It's like that type of thing where you might not see amazing results now, but because you know you're on a journey, you know that this potentially could be life changing. You know that maybe 10, 15 years from now, you could
But
be saying
you're
goodbye to your active income because you've brought up the passive so much
what
and your bills are covered.
what you're doing right now, your future self is going to thank you.
Exactly. That's right. Yeah. And also, not only that, the rest of your family may benefit as well from it 20
Yeah, for
years from
sure.
now or however many years from now. they could then inherit that. So they're assets which you can sort of pass down as well. It's not just
Right.
all selfish, just for me. It's, I think it will be hard to say someone will look back in 10 years and be like, I really wish I didn't start investing my money. That was a terrible decision. I mean, there are very few scenarios where you end up saying something like that,
Yeah.
which is why for anyone who's not already started, it's best to just get the ball rolling. Your
Yeah.
future
Just
version of yourself is going to be proud of that.
just get started, right? Just get
Yeah.
started.
Mm.
Yeah, I would say the only people that regret it are the people that, sort of go all in on something that they don't know enough about, and, you know, going all in is probably never a great idea on a single individual company. Whereas, yeah, diversifying your portfolio, like you said off the top, starting with ETFs, um, that's sort of the path to go. And take that path, and yeah, in 10, 15, 20 years, you're not going to say, "Oh, I wish I never did that," right? Like guaranteed.
Yeah. And also, 10 years from now, would you prefer to look back and say, oh, wow, I spent this much amount of coffee every day? I'm proud of the amount of coffee I've drank over the
Yeah,
last 10 years, or I'm proud of the amount of growth I've had in my investments. I think
yeah,
it's kind of a no-brainer, really.
yeah.
That's why anyone who's not started, I think, and especially because now with how technology has improved things, like we just saw the cost of legal in general, even with very small amounts of capital, you can pretty much get your journey started.
Yeah, exactly.
Mm.
Yeah, I didn't realize that it was that low of a barrier to entry to that company. So, yeah, like you said, you can get your journey started um, quite easily these days, right? Like we have free apps on our phones. You can, research topics. You can use Google and YouTube and Twitter and all sorts of other websites and resources, Facebook groups and whatnot. Although obviously you have to kind of be be careful what you find on social media, but at the same time, you can sift through the good and the bad and make an informed decision for yourself.
That's right. And also now, I mean, I don't know how it was way back, but you can buy fractional shares as well. So
Yeah,
even if it's a big company where you need maybe a couple hundreds to buy a share, you can still get involved with that by buying a fraction of that.
yeah.
I don't know what it was like back then, but from what I've heard, it wasn't as easy as we have it today.
Not nearly. There's been a few good guests. Some of the older folks like myself on here. Master P Optiguru. I think it's episode 41, maybe episode 40. And yeah, he explains how back in the 90s he would um, drive around with a roll of quarters so he could find a payphone, and he'd have a 16-digit pin written down on his wallet so he could call his stockbroker. Like,
Oh wow.
yeah,
Yeah, no, that sounds
totally
painful.
different these days, right?
Yeah, that's completely different. Now you can literally do it. I mean, within the next 10 minutes, I could buy a stock of anything if I wanted to.
Yeah.
But that way, having to call someone up and all that kind of that sounds like it was complicated.
Well, and the
Yeah.
stockbroker held all the power back then too, because they were the only ones with the access to the information, right? So it's
So
a
if you
totally
got a
different world now.
dividend, so if you got a dividend, you'd have to get that from the stock. The stockbroker holds it, and you
Yeah,
have to
if you
request that.
wanted to cash out your dividend payment, I don't know back then if uh, automatic drip was a thing. I think it probably was, but yeah, obviously nowadays it's so much easier for everyone, and so much easier for younger people to get involved and start learning and just get started, right? Just get on base, as I've said in the past, baseball reference. Just get on base.
Yeah, exactly. I mean, there's very few reasons why you would not want to get started now. Like you said, the apps are free. I mean, obviously some apps they do sort of take a percentage of if you buy a stock, they'll maybe take a small cut. But
Yeah,
pretty much I think anyone, obviously depending on the regulation in your country, but pretty much anyone can just go and buy something. Again, that probably means there's now more risk. People are probably more likely to then buy risky stock just because they can just do it. So that's why
right.
you still have to do your due diligence. You still have to research it.
So just to add to
Yeah.
your point there of like maybe these free apps, they might take a small little cut so that they're making money. Going back to the 90s, the commission generally was around $60 for a buy or a sell. So on every single trade, $60 commission. Um,
Oh wow.
in the early 2000s, when online banking first became a thing, and a lot of the banks started offering like online trading, the commissions started out at $29.95, and so they were like, "Oh, it's half the price of what you were paying." Like they were selling it as such a great thing.
Yeah.
Um, then by about the 2010s, the online banking had gone down to about $9.95 per trade, and I think some of them are still at that $10 per trade, which is mind-boggling to me because there's so many out there that are free apps or very small percentages or even like $1.99 or $2.99 a trade. So, um,
No, $60. That is, I can't
right.
imagine
So,
paying that.
yeah, the barrier to entry was much higher.
Yeah,
Again, you have to call a stockbroker. You have to be able to cover this 120 basically. You need to make a profit of 120 just to break even. So, yeah.
that's not ideal at all.
No, no.
No.
So much better these days.
Yeah. I did have a question for you though.
Sure.
Do you hold any UK stock?
No, everything I have right now is Canadian.
Everything's Canadian, so no US, nothing else, just purely Canadian, other than your ETFs, I guess, where you have that
Right. Well, even
diversification. Yeah,
the one ETF I have is primarily the Canadian banks within it, and then I also hold a couple Canadian banks individually, and obviously Canadian banks are huge, and they do have global exposure as well. So I I have no idea if they own. I know they own things in the U.S. and Latin America and South America. They could have things in Australia, UK, New Zealand, Europe.
that's
I
right.
I honestly don't know.
Mhm. Okay. Yeah, I don't think it's very common. I mean, I think just from what I've seen, I might be wrong, but I think a lot of us here, so a lot of UK investors, they do buy the US stocks, sort of any North American stocks, but I don't think it's reciprocated the same way where
N-
US might buy. I
no,
think because they have more choice and all the
yeah.
large cap companies are in the US anyways. So
The companies that North Americans would look at would be like you mentioned British Petroleum, Rio Tinto. One we didn't talk about is Unilever, but that's another one. So it's kind of like those really big
yes,
uh, top market cap companies that North American investors would look at, and again they would look at it exactly for that reason of global exposure. Um, but like you said, there's so many of the big companies just in the U.S., so Americans can easily build a portfolio of just American companies that has global exposure without even thinking about it too much, right? So
that's right. Yeah. And speaking of US companies, SCHD.
yeah,
I'll be honest, if I lived in the US, that would have been my number one pick. And
yeah,
I've seen a few guests you've had on here who spoke about it. I think you had Craig on
yeah.
some time
Craig
back
is
as well.
on Twitter, SCHD Stan, like the
Yeah,
Eminem song Stan. So
yeah, I've been
he,
following
he's
him for a while. He's a great content, but it's a shame we're not in the US because that's definitely one I would have had in my portfolio as well.
so again going back to the ones I'm on my US watch list. Actually, SCHD is the very top of that watch list. Number two in my US watch list is Realty Income, and number three actually is Coca Cola. So
Oh,
But
okay,
I'm really
Coca-Cola.
just, like I said, primarily waiting for the Canadian dollar to hopefully at some point next year or the year after to strengthen against the US dollar, so I'm not losing as much in the exchange rate.
Yeah, okay. And if that doesn't happen, I guess that means you'll never buy those. Just hold on to the Canadian ones.
Yeah, well, obviously the exchange rates fluctuate, and um, there's been twice in my lifetime where the Canadian dollar has been worth more than the US dollar, but that's short lived. Um, the first time it happened was in the 70s, and I was like 3 or 4 years old, so I had no idea what it meant or what it was. And then the second time I think was around 2006 or 7, and yeah, the Canadian dollar went to 106 versus the US dollar or something like that at the time.
All
So,
right.
um, but right now it's 70 cents on the US dollar, so it's like I'd be losing way too much on the exchange rate.
Yeah.
If it even went back up to say 85 to 90 cents on the US dollar, then that's where it's like, okay, it's a lot more reasonable for me to look at this now.
Hmm. That makes sense.
Right. Awesome. This has been an incredible conversation. I've truly enjoyed chatting with you here on the Passive Income Podcast. I can't thank you so much for your time and spending some of it with me. Before we sign off, do you have any final thoughts or anything you'd like to say?
Um, just well, for anyone who's watching, you've not sort of started your journey. I think safe place to start is maybe with an ETF. Obviously, don't take that as investment advice.
Yeah,
But if you are going to invest, that's probably a good place to start. Play it
do your own research.
relatively safe. Yeah, do your own research. We know that it's easy. All you have to do is download an app or visit a particular website, put your money in there, and then own a piece of the pie. Get your investment journey started.
Just get started.
Mhm.
Yeah, I'd have to say that's great advice. Well, not financial advice, but yeah, definitely just get started. And an ETF is a great place to start. But please do your own research. And again, thank you so much for your time. This has been a great conversation. And if you're still watching here, well over 45 minutes later, please be sure to subscribe.